Hey, Bowtie Nation, Joseph Hogue here. Thank you for being here for another Beer Money Sunday. Our live streams try to do every Sunday at 2 p.m. Eastern. Thank you again for being here. I love doing these to really connect with you out there in the nation, answer your questions, and kind of talk about the big topics of the week. See a lot of people there in the in the chat. So welcome, thank you, AK Fred, Grey Wolf. See you all there in the chat. So yeah, let's get this party started. And a big topic for you this week. Going to get started real quick here as soon as we see everybody be able to get in. But what happened to the markets this last week and really over the last 2 months. Actually had somebody in our private Facebook group that's called Let's Talk Money Together. They're on Facebook. Had somebody ask this week if we should be selling everything, see how bad the markets are getting, if we should sell everything now. And, it's a legitimate question, I guess, but obviously a spoiler alert, I don't think you should ever be selling everything all at once, especially if you're some of those long-term investors out there. So we're going to get right to it though. Grab your favorite beverage and settle in for, about half an hour. We'll get to that topic. Talk about the stock market, where I think it could go for the rest of the week, or for the rest of the month, the year, and then into 2021. See everybody out there. So let's just get started though. Again, love doing these every Sunday. I appreciate you being here and kind of having a chat here every Sunday. So what we're going to be talking about today, the big question obviously last week was that recent stock market crash. Is it real? Is it just a correction? How long is it going to last? And kind of positioning for the rest of the year as well as into next year. All three major market indexes, so the Dow, the S&P 500, and the Nasdaq are now down 2 consecutive months. So I think the Nasdaq is down the worst, something like 10% over the last 2 months, which is actually technically a correction. The S&P and the Dow are both down as well. Actually, the Dow Industrials just had their worst month since March. So if that kind of gives you any kind of an inclination of how bad it is and maybe how bad it could be. Market was down something like 3.5%, 4% for October. Not quite the crash that we thought could occur, but it's still 2 consecutive months down, and especially in a lot of these high beta names. So these tech heavy funds, the tech heavy Nasdaq down even harder, and it really makes you wonder if they can keep up the leadership that they've had through most of this year. The problem is you've got these tech stocks that have really been pushing the market higher, especially in some of the indexes like the S&P 500, which is actually almost a third tech. Okay, so the weighting in the S&P 500 is about 25-27% tech stocks. So when you do get that breakdown in tech, like we saw, especially last week, especially Friday, with almost a 2.5% shot to the Nasdaq, then that really takes away that leadership from the index. And if another sector doesn't come forward to really drive gains, then it's just going to be a one-way bet. So this video, we're going to talk about kind of the forces driving the market, how to invest, how I'm investing for the rest of the year, and then into next year. See a lot more people joining the chat. Florida, Massachusetts. Love seeing everybody from all over the U.S. and all over the world. See a lot of questions here. We'll get to those in the question and answer section after we talk about the markets for a little bit. Real quick, just a recap of last week's videos. Next week's videos coming up. Last week, talked about kind of how to pick an ETF. Really important video there for you. I think it was Friday. So check that out. Going to be some great strategies in that, how you look at ETFs, how you use that information to position your portfolio. Next week, a big week for the videos. 3 videos coming at you this week. For Monday, tomorrow is going to be penny stocks for the future, and really, I think a strategy that is going to surprise a lot of you penny stock investors out there. I see a lot of people in the comments on the videos talking about some of the picks penny stock picks we've had in the past, and how much they made, and that kind of thing, up 20, 30, 40%, and then they sell out. And yeah, it's great to get a 25% return in like a month on a penny stock, but that's really not the strategy that's really going to make you the most money in these penny stocks. And I'm going to talk about that strategy and really how you should be using these penny stock ideas in tomorrow's video. Wednesday, we've got the final daily dividend video coming up. Really excited about that one because the other two videos have been really popular. And basically we're putting together a portfolio of it ended up being 56 stocks that some of them monthly pairs, most of them are quarterly, but looking for that, and then I'll put that in the playlist that has those other two videos. Saw a super chat come through, $5 from PMO 1904. Thank you for that. I see you've got a question there. Go ahead and please ask it again when we get to the comments, when we get to the Q&A section, and I'll definitely be sure to answer that. Final video of the week on Friday. We got another monthly dividends video coming at you, and this one is going to be kind of ones you can count on for retirement. And I think that's important to make that distinction of maybe a retirement portfolio versus something else, because what's your longer term strategy for monthly dividend stocks might be different from a retirement portfolio of dividend stocks. So for monthly dividend stocks, you're really going to be looking at some of that safety and cash flows. So we're going to be looking at that on Friday. Got a notice from YouTube that it's the bandwidth is a little slow. Let me know if it's kind of jumpy or coming up. Now I want to get to that topic, the stock market crash. How bad was it? Why did stocks crash? Really the things that hit the market over the last few weeks, really over the last 2 months. And what's the outlook going forward? So first, let's talk real quick about why stocks crashed. Okay, you've got really three problems with the market right now. 3 walls of worry, if you will, is how the pundits talk about it on TV. You've got one is the stimulus just got taken out of the equation. Okay, it was near consensus that we needed more stimulus. We've known for months that we were going to need more stimulus to really push the economy, as well as the job market has rebounded. It's still tens of millions plus, unemployed. And then, global trade is down quite a bit. Energy prices, obviously, or energy stocks, and a lot of that sector is down. So it's been near consensus that we needed more stimulus. We just couldn't get to how much stimulus, okay? There was a lot of talk on both sides of it, and and that just got everybody's hoping on some kind of stimulus before the election. Obviously, that got taken out of the equation, and now there's a big question mark over when might that get passed. Okay, if it's going to be during a lame duck Congress, which would be from November 3rd, from next Tuesday until January 20th. Or whether we're going to have to wait till even further out after that. So that was obviously, something that the market had to recalibrate its prices. The uncertainty around the elections, that was another one. And even if, a lot of people are saying that, myself included, that the election isn't necessarily, a big deal for the markets right now, because we're pretty well certain we're going to get some more stimulus from either side. As well as some of the other things that we need, but there's still that uncertainty, and the markets hate uncertainty. Investors hate uncertainty because it makes it harder to plan, where to position for. So obviously, getting closer to the election, and that just kind of hit the markets. Third is obviously this coronavirus surge that we just got globally over the past few weeks. There's less likely it's going to lead to lockdowns in the United States, even though we did hit 2 consecutive days of all-time highs in infection rates. I actually hit something like 100,000. I think it was Friday, 100,000 new cases in the U.S. The EU, Europe has locked down. Germany and France have reinstituted their lockdown measures. So obviously, not only the effects on global growth, the global economy from that perspective, but investors in the U.S. are just worried about, are those lockdowns going to be coming back to the U.S. when and how bad those are going to be. Now, again, even with these higher numbers, we are seeing the mortality come down a little bit, especially since the earlier parts of April and May, just because we've been able to triage the care a little bit better and some of the treatments that are out. And I think there's just no there's no mood there for any more lockdowns from anyone really. The impetus really is more on other things, other measures that we can do as far as making people wear masks and things like that, which you may not like them, but they don't necessarily hurt the economy. Okay, wearing a mask doesn't hurt the economy. We can still be out and doing our business and doing whatever we need to do. So I think that's where states are really going to go before they have to institute those lockdowns. So those are really the three biggest things that did hit the stock market over the past few weeks, especially last week. And you got to ask yourself, okay, so that combined with maybe some of these other forces that are driving the market, are those near term, short term kind of things, or are they maybe going to be a little bit more lasting? And when do we clear those and allow the market to go higher from here? So obviously, the election is a big piece of uncertainty for the market, but that's going to pretty much clear out. Okay, we won't know Tuesday night probably who won, and that's especially because Pennsylvania is looking like increasingly likely to be the state that kind of decides the election. Just by the way the Electoral College is coming out. So in Pennsylvania, actually, they cannot start processing their mail-in ballots, which is upwards of around, I want to say a few million already. They can't start processing those until 7 a.m. Tuesday. I'm not sure why they haven't changed that. A lot of states, especially even Florida, has changed theirs to where they can start processing earlier, so to be able to give us an idea of where those are coming through. Way earlier, well earlier. I think Florida started something like 2 or 3 weeks ago, started processing some of those mail-in ballots. But again, Pennsylvania doesn't do that. In fact, 7 counties in Pennsylvania are now saying that they're going to wait until all their election day votes are tallied before they even start on those mail-in ballots. So it's looking likely it's going to be probably about Friday before we can really definitively say who won the election. That said, it's still going to be a lot of uncertainty out of the market, I think. I think everybody's pretty well bought into the idea and understands the idea that it's going to take at least a few days to tally up this historic mail-in and early voting movement. So I don't think having to wait till Friday is really going to hurt the markets too much, and it is going to be one less concern for the market. Okay, whether either one wins, we're not going to talk about the politics here this week, but whoever wins, it's going to be one less worry for the market, and I think that's going to be helpful. Really, right now, it's just a race against time for the vaccine versus this recent surge in cases. Like I said, I think states are going to go to a little bit more strenuous face covering restrictions before they do any kind of lockdown. There's no appetite left for lockdowns, that kind of thing. And we've got Moderna, we've got Pfizer, we've got AstraZeneca. All three of them are late stage 3 trials. Moderna actually, I think, just said Friday that they're still on track to release their data, report their findings on stage 3 sometime, second, third week at the latest of November. Pfizer has also said third or fourth week of November, they're going to be reporting their findings, and that's going to go straight to the FDA, straight to an emergency use authorization. So by the end of November, we could have not one but 2 coronavirus vaccines that are given emergency use and are starting to be distributed. Obviously, that's going to be a huge sentiment boost to the economy. People are going to be able to look past, I think, some of the surge in infection rates. Not to belittle that surge. I mean, there are still 1,000 people dying every day from this. So, be safe, protect the ones you love. But I think as an investor, I think the market's going to kind of look past that pretty quickly once we get some kind of a vaccine. And then, so of course, the third hurdle, I guess, for the economy or for the markets is just that stimulus. So, there's still some hope that we're going to get more talk about a lame duck stimulus program or stimulus conversations. I think you'll get it in parts. Okay, first you'll get some talk about the talk, that they're back talking, talking about the stimulus, and they're trying to get something through. It's going to help boost the markets a little bit. Obviously, the market isn't going to buy into anything until we get some kind of a deal. So hopefully they can move that through there. Taking those three together, I've been cautious with a lot in cash and bonds and covered calls since pretty much August, maybe a little bit before that. And you really have to make the distinction between yourself as a private investor trying to grow your wealth and your investments versus maybe the advisors out there and the pundits on TV that are talking to advisors or trying to help people beat the market or something, right? Because, as an advisor managing someone else's money, you have to beat the market, right? That's your livelihood. And if you can't beat the market, then somebody's just going to say, well, you know what, I'm taking my money and indexing it for passive investing and not have to pay your fees. So they are going to be giving out, this daily advice and trying to beat the market and everything. As a private investor, though, I think, I think you need to be a little bit more rational, a little bit longer term thinking, and say, okay, you know what? I don't know if over the next 2 months or 2 months even, if stocks are going to surge ahead or follow this trend lower. But it doesn't matter. I don't have to be right on it. I don't have to beat the market every single month. Okay. So, maybe I am a little bit more cautious in cash, have a little bit more bonds and have covered some of my positions with those calls, selling those call options. If the market rebounds a little bit, I miss out on that, but I also protect my downside, and I have that cash ready for if the market does sell off. So that's what I've been doing a lot since midsummer, right around there, July, August, that kind of thing. Positioning a little bit more in cash, taking advantage of that huge run up. I think the Nasdaq's up something like 60% so far since the March low. Which is huge, and you just don't get that kind of a gift that often. So I'm taking that gift. I positioned a little bit more in cash and bonds. I am slightly more bullish still for the rest of November and December. I think the election is going to take that uncertainty off of the markets. We're going to be able to stop worrying too much about that. Like I said, the market is really intensely focused on this vaccine authorization coming late November, early December. So I think that's one more thing. And then obviously, the stimulus talks will come back. It's just a matter of when and how much we get. So there are some shorter term upsides to the market. And what's really interesting, one thing that we saw this last week is kind of a disconnect, a huge market disconnect, is the steepening of the yield curve. Okay, now, if you don't know, the yield curve is just the different interest rates at different maturities for the U.S. Treasuries, right? So you've got those very short-term treasuries, the 3 months, the 2 years that are, like zero, basically, right? The federal funds rate is basically like 0.1%. Okay, basically zero. And then, as the bonds are longer dated, then investors want more interest rate to take that longer term risk, right? So the 10-year is actually at 0.87% right now. The 30-year, I want to say, is something like 1.2, 1.3%. I got to check that. But so what you get is this yield curve, the different interest rates at different periods of bond maturities. And off of this, of course, everything else is priced. All these other interest rates are priced. And what is really interesting here is that the yield curve actually steepened this week. Okay, the short term down here at the 3 month, the 2 year really short term rates, that's very much what the Fed is doing with rates. Okay, and the Fed isn't moving on rates. So they're keeping this short term interest rates anchored to basically zero. And the longer term is pretty much what the market is thinking about: inflation, economic growth, things like that. So basically, the market, sometimes will say, okay, we're looking at inflation pretty soon in the future. We're looking at better economic growth, better economic activity, that kind of thing. and interest rates will start to rise, right? Because interest rates are basically kind of the cost of money. So when you get that steepening of the yield curve, it's a bullish sign, really, for the market, for the economy. And what was really interesting is that while we saw the stock market sell off because of some of these factors, these hurdles, we still saw longer term interest rates come up a little bit. So I think a lot of the market is looking at you've got some of these short-term factors like the surge in coronavirus, like the election, a lot of these short-term things, but a little bit longer term, it's more positive. So I think that tells you that you can be a slightly more bullish here than maybe the last 2 months have kind of indicated in the market. If you're looking at that, that's part of the reason why I'm positioning in financials for next year. Obviously, financials, so the banks, they make their money on that yield curve off of the difference from long-term rates and short-term rates. So I think financials can do really well. Energy also had a really strong earnings season, okay, though it was kind of drowned out by the lower oil prices, right? So oil prices came down from $41 at the beginning of the week to I think $38 per barrel on the WTI, the West Texas Intermediate, towards Friday. So of course that drug down the price of oil companies and energy stocks, but they actually had a really good earnings season. Okay, Chevron blew away the estimates. They were expected to report something like a negative, so a loss of 26 cents a share, and actually reported a gain of 10 cents a share. So we're actually able to remain profitable. I think RDS, Royal Dutch Shell, actually reported. They might have reported negative earnings, but they were actually able to increase their dividend. They were actually able to increase their dividend because just the outlook is less negative. So energy actually had a very good earnings season, and they're pulling back so much on production spending, on investment spending, that we could easily get to a production deficit in oil throughout this next year, and that's going to push those prices back up. As long as the big wild card there is, so it's not necessarily, the wild card isn't necessarily the oil supply from the U.S. side, because we're pulling back so much on production, but it's whether OPEC and OPEC plus, so with Russia, is going to play ball and keep that supply down to allow energy prices to go up. But yeah, I'm in financials, energy. So that's kind of the short term, that November, December, even January time period, a little bit more bullish as we get some of the coronavirus, the elections, and that kind of thing behind us. Over the longer term, it's going to be a little bit more of a wait and see kind of idea. As we do get into later January, February, March, the market is still very expensive right now. Once you move outside of some of these value sectors like energy, healthcare, financials, utilities, even some of those value sectors, you look at the rest of the market, especially tech, consumer discretionary, and they are still very expensive. Okay, so again, with that idea of thinking about it in terms of yourself as a private investor, not having to beat the market all the time, but simply protecting what you've made, those prior returns, and waiting for better opportunities. I think at that point, so February, March, April, I think you can start to pull back a little bit, take some of those profits, because we need to see a hell of a lot faster economic growth, a hell of a lot better earnings to really be able to justify some of the prices in some of these sectors. So that's kind of what I'm looking at, kind of what I'm thinking as far as the stock market crash recently, where the market can be heading. Again, I think I think a lot of these worries, or these walls of worries, are going to be coming out of the market fairly soon over the next month. So now I want to get in the Q&A section, and again, I don't know why I have to say this every single week, but that's enough with the political commentary in the chat. Okay, this isn't the place to try to boost your favorite candidate, or say something about the other candidate. There are plenty of channels on YouTube for that. So let's keep this about investing, about how to make money, and doing that. So now I want to scroll back up and look for some of those some of those questions. If I don't get to your question, please ask it again down in the comment section below. Make sure you add a question mark so I know it's a question. Start off, we had actually Mark was here before the live chat started, wanted to know about the Cenovus Husky merger. Two Canadian oil companies there agreed to a $23 billion merger just this last week, I believe. Now, I haven't really looked into either of those individual companies, but this is a lot of what we're seeing in energy right now, okay, is these all stock transactions. So, and a lot of these, the pieces to the mergers kind of give us a clue at where the market is at, right? So, when energy prices are up and the companies are doing really well, they'll start doing like, cash transactions, cash mergers. Right now, what we're seeing is they're all stock transactions, right? Nobody wants to pay cash. Nobody really has any cash, but nobody's paying cash for these mergers. So you're not seeing the big jump in prices that you used to see for when a merger is announced. And it's really these mergers, they're all driven by cost cutting. Okay. I think Cenovus and Husky, just from the headlines that I read, they're thinking that maybe they could cut something like $1.3 billion in costs, in expenses from that. That's a lot of that's going to come on lower workforce. I think they're talking about a 25% reduction in combined staffing at those two companies. So, and it's really, a big clue into where energy is right now. These companies, they've pretty much exhausted all their cost-cutting programs, and they're basically either, okay, we got to merge or die. So we're merging with another company where we can cut more costs off of staffing, or we're just basically at the mercy of those oil prices, right? So, I think a lot of these, the mergers, not necessarily good or bad, they're basically being made out of necessity. So it's going to be a long time before you see any kind of benefits from that as far as economies of scale, so larger companies being able to operate more efficiently and that kind of thing. But it's if it makes sense as far as kind of the product distribution and that kind of thing. I mean, it's never bad to be able to cut those costs and be able to come back into the market when energy prices are higher. Right now, and my position on energy over the last few months has been really the stronger, the larger established players. So you've got a lot of the integrated players like Chevron. I've had a position in Chevron for a couple of months. Like Royal Dutch Shell, RDS, Total is actually doing pretty well too. I think CVX, so Chevron and Total, ticker TOT there. We're actually the only two companies to come into this whole pandemic, into the whole end of the year, doing very well operationally, and I think they're probably some of the best positioned. But again, I think the way they're pulling back on energy production in the U.S., we could be to a deficit in production very soon in the next year, and that's going to help support those energy prices. What else I want to see? We had another couple of questions here. Thinking of buying Phillips 66. Somebody asked, I really haven't looked at Phillips 66 a whole lot. The problem there is they're much more on that retail side. So, I think that's going to be a harder bet until we get into that summer driving season. Okay, so obviously, anytime a more downstream, positioned company like Phillips 66, which has more refinery margins, and then retail sales to customers. You really got to look at, okay, what part of the energy market is going to rebound faster? And I think at this point it's probably going to be the explorers that are going to start to see that lower supply, the lower oil supply and gas supply affecting prices, and they're going to benefit first on that. And then you'll start to see some of these downstream players like Phillips 66 do a little bit better there. What else? So Kobe wants to know if it's time to halt allocation to big tech. I love that question. It's a great question because I think investors need to look at their allocations to each sector, okay, and where they're positioned, where their risks are. Obviously, and I think a lot of people out there, they have 30, 40, 50% of their investments of their portfolio exclusively in tech, just because it's done so well. And that's never a good idea, no matter where the market is. Okay, you need to be somewhat diversified. I'm not saying you have to have, positions in every single sector and that kind of thing, but if you want an extremely volatile portfolio that's going to sell off anytime a tech bubble pops, then yeah, be all in tech. Otherwise, I would start to honestly, rationally look at your portfolio and say, okay, you know what? If I'm more than 20, 30% in tech stocks, then yeah, I need to be looking at some of these other, some of these other sectors. And again, personally, I'm looking at more of the value sectors. I think, going forward, once we get the economy back, then I think there is going to be that rotation from growth to value stocks and some of these value sectors. Okay. Tech has had an amazing year this year. Long term, it's a great sector. You'll get a lot of growth there, but the valuations here, as well as just kind of that sentiment. If people are getting back to their lives as normal after this vaccine comes out, then they're going to start doing some of the same things that they used to do. They're not going to be online all the time. And a lot of these tech stocks, these tech companies in the tech sector as a whole, isn't going to be benefiting from it. So I think you will see some kind of a pullback in tech as some of these value sectors and these other sectors and these other stocks come back. So halt allocation to big tech. Yeah, I would hold off. Definitely, I would wait for a little bit better value opportunity in that and take advantage of some of the prices and some of these others. What else? PMO 1904 had that super chat earlier. Thank you again for that. What metrics should I be looking at to ensure I don't overpay for stocks? I feel I buy high a lot during this recovery and then fall. Okay, yeah. We've got a couple of videos on the channel about some of the ratios that we use, the metrics. Now, as far as valuation is concerned, you can use some of the standbys like PE. Not a big fan of the PE ratio, but it is an easy one to use. What I like a little bit better is something like the enterprise value to sales ratio, and you'll find that on any investing platform. I believe on Yahoo Finance, you go to the statistics tab on any stock, and there, about 4 or 5 rows down, it's going to show you that EV to sales. And why I like this is for 2 reasons. One, okay, so the denominator, right, the sales, much less easily fudged than net income or earnings, right? So if you look at something like the price to earnings ratio, then earnings, by the time you get that number, that's just sales. There are very few ways to fudge that sales number. So it's just a much purer look at what the company is making and and to use for valuation, right? So I like whether you're using this EV, this enterprise value to sales ratio, or maybe even the price to sales ratio, that's fine too. But I just like using sales rather than earnings for a valuation metric. Now on the other side here, the numerator, so your enterprise value, why use that rather than price? Okay, so now enterprise value is basically the market price of the whole company, right? So the market cap, it's the total value of shares traded, minus out cash, but then add in debt. Okay, and this is really interesting how this works is. So if a company is going to buy this company, or as an investor, you're basically kind of acquiring a piece of this company, then that cash on their balance sheet, that's you could take that right off of the price, right off the top. But you're responsible for this debt now. Okay, so all the debt, basically the long-term debt that the company owes, anybody acquiring the company in a large chunk is going to be responsible for this debt. So what you're using by that enterprise value, which again is the market cap, the total price of all the shares in the market, minus the cash plus the debt, divided by sales, it's giving you just a truer picture of really the valuation of this entire company with its cash, with its debt. And you really don't get that with just a price to sales or even a price to earnings ratio, right? With the price to sales or the price to earnings ratio, all you're getting is just that market cap of the company, the price of the company. And it really hides a lot of the debt problems that a lot of these companies have, right? So, if a company has just bucket loads of a mountain of debt that it owes, that's not going to be in that price to sales or price to earnings ratio. So the EV, enterprise value to sales ratio, one of my favorites for valuing the stocks. And again, you'll find that on just about any investing platform. On Yahoo Finance, the statistics tab, come down about 4, and you'll see EV to sales. Again, what you want to do when you're using any of these ratios is two things. One, you want to compare that company with other companies in the industry, in a same industry. It's got to be industry to industry, same industry, because those multiples are going to be different across different industries, right? You can't compare the valuation on a tech stock against the valuation on a consumer staple stock, okay? The fundamentals of those companies and that business model is just too different, okay? You have to be comparing a tech stock with a tech stock, a consumer staple stock with a consumer staple stock, and preferably even within that sector in the same industry. Okay, so you wouldn't necessarily compare within the tech sector. You wouldn't necessarily be right if you're comparing a software company with maybe a hardware company, right? Because again, the fundamentals are going to be very different for those two industries even within the sector. So again, preferably industry to industry when comparing stocks. You also though want to look at the trend in that same company. Okay, so if you're looking at the enterprise value to price or enterprise value to sales ratio of a company right now, where did it trade a year ago? Where did it trade a quarter ago, or over the long term? Has that stock become more cheap or less expensive over the past year, and why? So two great ways to use that ratio to really make sure you're not overpaying for the stocks. Again, also when you're looking at buying stocks and trying to think of whether you're overpaying for one, you kind of got to look at the market as well, the overall market sentiment. All right, and right now, a lot of the market itself is very expensive. So you've got to think, okay, even if I find a good value stock right now, if the market comes down off of that high sentiment, off of those expensive price ratios, those price multiples, then is that going to hurt pretty much all the stocks as well? So you got to be kind of cognizant of that, and maybe kind of hold some of your money back for investing at a later time. There's also and this last point on this question, there's also a point where you got to say, okay, you know what? It's not so much getting the best deal right now, finding the best stock, but just that regular investment. Okay, I don't care if you're a Netflix investor and you've been investing over the past 10 years. I don't care if you bought at each peak in the price. You've still done very well. Okay, even as it's come down this year. If you've been buying over the last 10 years and you were to buy it at the peak of the price at each point, each year, you would have still been a very, very happy investor. And that's kind of the mentality you have to take with a lot of this as well is I'm going to invest every month, put part of my paycheck in stocks and not worry too much about prices at any one point. But great question again. Thank you for that. Okay. Noble Speed Motorworks, thank you. Thanks for that as well. Do you think electric vehicle market will drop more, tank, or hold steady for the rest of the year? Tesla, NIO, Workhorse, Nikola. For electric vehicles, I mean, the writing's on the wall. It's going to be a very big part of the of the economy, of the global economy, and of our lives over the next 5 and 10 years. The problem with this, though, and this is the same problem we get with cannabis stocks, with 5G to an extent, but with some of the Bitcoin related stocks, it's much more about the current hype than it is that long-term thinking in it. So you've got to watch out for the stocks that are overpriced on that hype. How much of the future earnings, the future sales are already built into these, and that kind of thing. So right now, I think, and I haven't checked a lot of these. I haven't checked that theme for about a month now. I know Tesla, a lot of these have come down quite a bit, and that's what you get when these high beta names, any kind of a market sell-off, it's going to hurt the high beta names, these expensive names first, these growth stocks first, because investors start to question that future growth. Again, though, I think you got to look at it as kind of what we just talked about in some of those the streaming names like Netflix over the past 10 years. You can invest, and in 10 years you're going to be very happy, no matter where the stock is right now. Tesla's obviously, I think, in a little bit of a different area from some of these others, the Neo, Workhorse, Nikola, which are very much more startup companies. Still, Tesla is, still much more of an established company. With Tesla, I'm not. I've been a bear on Tesla, and not necessarily a sell side saying to sell the stock, but just avoid it. I mean, I'm not going to invest in the ups and downs on Tesla unless I see it come down quite a bit dramatically to where it's kind of a slam dunk, right? Which obviously keeps me out of Tesla for a lot. With these other ones, though, I think you can treat them as startup investments, right? So maybe buy all three, okay? Buy some shares in Neo, Workhorse, and Nikola, but make it, no more than 5% of your portfolio. And that's maybe 5 or 6% of your portfolio in all three, okay? So maybe 2% at the most on each. One might totally flop, and that's how it is with startup investments. When I used to work with venture capital investors as a venture capital analyst, the idea is you make 10 investments in startups, 3 to 5 are going to return either zero or less than your original investment. But then you get those 3 or 4 that go on to 20 or 30 times your return. And that's what you're doing with these startup investments. Okay, you're not worrying about that short term, what they're going to do short term. You're holding on, even if some come down dramatically, they look like they're going to flop. You hold on, and you just let it play out for 5 to 10 years, because you will get enough at that 10 and 20 and 30 times your money that it's going to average out your portfolio to, actually what it ends up being is about 25 to 30% portfolio return on these startup investment portfolios. So, long story short, on electric vehicles, if there's a lot of hype still in the market, not quite as much as during the middle of the year there was. So the prices have come down. I think you can start your position here. Maybe wait a little bit longer for a little bit better prices. But just understand there's going to be those ups and downs in that market. But it's much more of a startup venture investment than some of these other stocks that we look at. What else are we looking at? Oh, wow. Yeah, a lot of misinformation out there, folks, about COVID. People are dying. Thousands of people dying every day. And if you want to look at it, I mean, what does it cost you to wear a mask? It doesn't cost anything. It's a slight inconvenience, and you can save lives. So let's just stop the bullshit about whether we should lock down the economy or what's going to happen. All we got to do is just wear a mask, okay? Wear a mask. Don't be in somebody's face, 2 feet from their face. And I mean, we can stop the spread right there. But there are part of that hesitation as we go into January and February and March. In my thinking is that idea behind the vaccine, the herd immunity. I think it's going to be much harder to move on from this and start seeing those caseloads come down significantly and start seeing that life back to normal, because you have to get people to take the vaccine. You have to have an efficacy of 60 or 70% or better. And it's got to work its way. You've got to build up that herd immunity. And right now, with so many people saying that COVID is a hoax, or saying that they're not going to take the vaccine or whatever, it's going to take us a long time to get to that kind of herd immunity. So that's part of the reason why I'm thinking, okay, November, December, January, we're going to have a little bit better market sentiment across. We got a vaccine. We've got the election is behind us. We've got maybe more stimulus. So we've got those short-term boosts to market sentiment. But then in February, March, as we move into spring of next year, the reality starts to set in. The reality of 10 million plus people unemployed. The reality of, okay, even though we've got a vaccine, people aren't taking it, or it's not yet reached that herd immunity. And people are still consumer spending. It hasn't quite rebounded and things like that, and we start to see a little bit more of those bankruptcies. So I think as that reality sets in and it hits on earnings, then yeah, I'm a little bit more hesitant that part of the market. Uh, what else can someone say if the stock market? Okay. What else? I'm trying to get through the questions. Again, if you ask a question, please just put a question mark on there. Um, what? One question here is in Russian, so it's been a long time since I've tried my Russian. So please just put that in English. Spasiba, right? Please. What banks do you prefer? Good question. I do like the financials, and part of this is if you're looking at that top-down approach, so you're looking at a steepening yield curve, banks being able to make a little bit more money, then you're starting with a very good position because that macro, that top-down idea is going to help all the financials at once. So I mean, you can be in the financials. Personally, I like the commercial banks. So anytime you're looking at financials, banks in particular, you got two types. You've got market banks, capital market banks, and you've got commercial banks, right? So if you're looking at something like a JP Morgan or Goldman Sachs, they're much more into the capital markets, investment banking, bond trading, stock trading, that kind of thing. They do still have retail locations and branches and make loans, but they're much more of a capital market bank. The other side, those commercial banks, which make their money more on the lending, which is going to be your Wells Fargo, your Citi, your Bank of America, though they have a pretty big capital market exposure as well. So what I'm looking at and how I'm positioning it for financials is, yeah, the capital market banks have done relatively better just because they've kept making money from all the IPOs this year, from all the mergers and all that kind of stuff. This year they've done better. What I'm looking at in the turnaround, in the rebound in financials, is then those commercial banks, and that's where you're going to find the lower valuations, obviously lower price to sales or price to book value, which is really what you want to look at when you're looking at banks is looking at that price to book value for valuation. So I'm looking at the commercial banks. One, they've put a lot more money from their earnings, from their income statement into that loan loss provision, right? Which again, that's just a special cash account that these banks have set aside just in case commercial loans start defaulting at a greater rate, right? So, and what I'm thinking is if the economy doesn't get as bad as they're expecting or if they're estimating, then they can take back a lot of these loan loss provisions, this cash in this account, put it back into earnings. Okay, so that's going to benefit these commercial banks more than maybe the capital market banks. Also, as the yield curve steepens, if it continues to steepen, then the commercial banks are going to make more money, right? Because obviously they make more money off of the loans and the loan spread. So I'm much more in commercial banks. So again, Citi, Wells Fargo, some of those lending banks. Energy sector again. AI or AY wants to know about MLPs, XLE, XOM. Again, I'm bullish on the energy sector over the next year. I think we do go into that supply deficit, which is going to support prices going up. It's going to be a little shaky, a little touch and go right around OPEC meetings because the OPEC plus, so OPEC plus Russia have to agree not to raise the production on their side, and the lit prices come up. But I think I think this is pretty much the trough for a lot of these energy companies. So I'm in the AMLP, which is the fund that holds those MLPs. I actually have a little bit of the XLE, but I prefer to invest a little bit more in the individual companies because I want to make sure that the companies, they have that financial flexibility, survivability to at least get through the rest of this, right? So again, Chevron, RDS, Total, Exxon has a little bit higher production costs, so it's going to be a little bit harder for them. Autumn JKD wants to know about Zoom and remote work stocks. Great question. Obviously, something I kind of touched on earlier is once you get that transition, when we get that transition from a COVID lockdown mentality into more life as normal, then you're going to see, I think you're going to see a lot of the hype, a lot of the valuations and the multiples come out of these remote work stocks like Zoom, like a lot of these. Not to say that they're not great long-term stocks, but once if you get those multiples coming down, people kind of stop talking about them. They stop getting new investors rushing into the shares. That's going to hurt the prices. Okay, so I am, like we talked about, kind of slowing down the allocation to tech a little bit earlier. I'm pretty much set on my tech stocks for right now. Obviously, the probably the exception there is Fastly. Has dropped down from like $136 a share at its peak down to about $65 a share now. Still well above. I think when we recommended it last November, it was right around $20 a share. So it's still about 300% return there. But I am definitely looking at Fastly, add a little bit to my position on Friday, and I'll look for that to come down even more and add even more money to it. A lot of that has been, take another drink here. A lot of that has been the news that Twitter has scaled back on their purchases of their services. But Fastly, this is a company right in the right in that trend to streaming services and that kind of thing. They're going to be benefiting from this from that trend for decades. It's a great stock, and I am definitely looking for buy points on that. As far as some of the other ones, I think I would let them come down a little bit over the next few months, especially if the market rebounds the rest of the market, some of those other sectors, and leave some of those tech stocks behind. Robert wants to know about cruise stocks. Another one. I would be ready to dip my toes in some of the airlines, maybe, and we've talked about that. I like Southwest over some of the other ones just because Southwest needs to have fewer seats occupied to actually make that profit. I think they're right around 70% load factor or capacity to where they're starting profitability, whereas something like American Airlines is much higher, around 80% they need filled. I would probably be a little bit closer to investing in some of the airlines before I would the cruise stocks. Okay, and the cruise stocks. Actually read an article last week or week before talking about the moratorium on cruises out of U.S. ports, and how it was set to expire. I think actually like last week, right? Which was kind of a political decision to let it open up then. But and then there was some argument, some back and forth in the administration whether to let that expire, to let cruises start docking again at U.S. ports and stuff, or to extend it to January 1st. I think they were talking about extending that moratorium, and yeah, it is going to be a long time before the cruises are anywhere out of the woods. Okay, these are, if you're worried about being on a plane for 3 or 4 hours and getting coronavirus, what are you thinking about being on a cruise for 3 or 4 days? Okay, so these things not only is there very little to say that the businesses are coming back yet, and they're going to be able to start onboarding cruise goers, but that longer term question mark is still very much in there. So I would wait on cruise stocks. Obviously, when we get a vaccine and we get some of these other hurdles lifted from the market, and that you could see a bump in them, but I'm not willing to make that call yet. I'll be in airlines or some of these other stocks have a little bit better financials, a little bit better balance sheet. Still get a boost when we get the vaccine and some of that other news, and I'll wait on cruise stocks to see they're in a little bit better position. A lot of these stocks, the hardest hit, cruise stocks, airlines, even out to like Boeing, you got to understand that they have taken on so much debt over the past few months, or over the past 6 months, that it is going to be very much a short-term and a long-term trading strategy or investing strategy. Okay, I mean, there's nothing wrong saying you can't go in there, enjoy the rebound in some of these stocks, in the airlines or in Boeing or whatever, but then you need to set an email reminder, okay, because you cannot miss this. You do not want to miss the getting out before that long-term investment plays out, because there is so much debt on these. It's just going to be very hard for them to make money over the longer term and to be able to grow beyond that initial rebound that we get. So can they make good stock returns in 2021? They can, as we get some kind of back to normal valuation multiples on these stocks. But longer term, I think it could just be dead money for a long time, or worse, or a lot of bankrupt companies. So be sure to watch out for that. If you are in these cruise stocks, the airlines, some of these hardest hit industries and stocks, understand, hey, get your money. Enjoy the return, take that gift while you can, but longer term, you really gotta think if this is a company that's going to be around and going to be able to pay these debt payments that they've taken on. What else? Just thoughts on the JETS ETF. That's ticker JETS. That's the kind of the airline sector or the airline industry ETF. I mean, that would be another good way to play it. Obviously, since any ETF, but obviously this one specifically, since it is diversified across all the companies in it, then it's going to be a little bit safer. You're not going to have to worry about those individual bankruptcies in each one. But obviously it's not going to rebound quite as much as some of the individual names either. Haven't looked at what's actually in the jets lately. I'd imagine there's a lot of Boeing there, a lot of the large major carriers. Whether you go with some of the top individual names or go with that Jets portfolio, I think is either way. I think the ETF is actually kind of expensive on an expense ratio. So you might be better off just looking at seeing what's in that portfolio and just investing it yourself in some of those individual stocks that they're buying. Okay, what else do we have? Do you think the boom in the housing market will boost home builders and supplies? A great question. Talking about the EEI 43995 wants to know, do you think the boom in the housing market will boost home builders and supply in 2021? Housing has been surprisingly resilient throughout this whole thing, but I mean it's just hard to see how it keeps growing and how some of these macro factors don't start to weigh on it. Okay, so housing, part of the reason why prices have been going up is because people just are sitting on the market. They don't have their houses on the market to sell, right? So there's still modest demand for home buying, but nobody's putting new houses on the market. So you've got a lot higher prices, and that's obviously supporting the housing market. Now, a couple of things here, though. One is what happens when, we do get back to some kind of life as normal, and all these people that have wanted to sell their house over the last year or two, but have held off, what happens when they come back into the market? Okay, obviously that is going to be a ceiling on prices now instead of that floor of support. So that's one thing that I think is going to hurt. The biggest thing, though, is eventually we're going to have to deal with these eviction moratoriums. Okay, and it's something nobody wants to talk about. It's something that Congress has kicked the can down multiple times. And you had to protect people through a few of those months when the economy was locked down and nobody was making any money. But now we're up to about 6 months. Okay, now that a lot of people haven't paid their rents, haven't paid their mortgages for 3, 4, 5, 6 months. And it's basically going to be impossible for them to get back to that once those moratoriums are lifted. Okay, so eventually, unless Congress comes through with an amazingly generous offer just to pay off a lot of this rent and a lot of these mortgages and stuff, or the back rents and mortgages owed, which it's a possibility. I think there's the probability is that we get some kind of rent relief, mortgage relief bill that's pushed through, but it's not going to address the entire thing. You can't. There's just so much owed right now on these mortgages, on these rents. So eventually the market is going to have to deal with that, and you're going to get you're going to get foreclosures, you're going to get evictions, and you're just going to get this wave of property on the market, not only from that, but from people that are tired of waiting and want to sell their house. So it is just very hard to see the housing market do nearly as well in 2021 next year as it did this year. It's just very hard to see that happening. Okay. So, I mean, as far as the home builders, suppliers related to the housing market, the construction companies, I would be hesitant on those. Looking out into the larger real estate market, and a lot of you have asked about REITs and the real estate market, REIT stocks and stuff. And here again, you've really got to look property types by property types, okay? Because office space is going to be very challenged over the next few years. Even as people do start going back into the office, that shift to work from home and remote work, that doesn't get set back all the way. Okay, we're still at a very high percentage, and it's just going to keep on growing. Okay, so you're going to have this excess supply of office space, of inventory on the market. Same thing with retail. I mean, people will start shopping again, and the malls will do marginally better and that kind of thing. But it's always going to be that fight against e-commerce and the shift to online shopping. So again, like we talked about, some of those hardest hit stocks, you could get a big bump, a real quick bump in 2021 for office space REITs, for retail REITs, for some of these retailers individually. But longer term out, it's going to be a very challenging environment for those companies. On the other hand, you've got property types like like industrial, which is just having a heyday with all this warehouse space that is needed for e-commerce, right? Anything you buy online, it's got to be stored somewhere. So warehouse space and that industrial and logistics space is at a prime right now. So so that sector is going to do well. Obviously, the data centers REITs are doing very well. The cell tower REITs are doing very well, and those are the trends that are going to continue and are going to do well. And if you look at those to buy. Somebody's asking about Ford. I've been in Ford for probably about a year now. I've had dollar cost average down to about 650 a share, something like that. It is starting to take off. I think it's it's about $8 a share now. So doing really well. I would be a seller of Ford right around $9-10 a share. It's going to be hard for it to get any further than that. So there's some upside still, I think, in its position for electric vehicles, and for that it's so as well as just generally a valuation rebound. But I would be much more bearish on that versus maybe something like a GE. Okay, I think GE had an excellent earnings session or earnings call just this last week or two, and is positioned. It really took a hit in the energy and the aviation segments. Aviation and healthcare were two of its best performing segments over the last few years, really holding up the company, holding it out of bankruptcy, and then those got hit. But it's managed to cut costs and support some of these other sectors, these other segments, to where that wasn't so much of a hit. Now what we see, if the aviation segment comes back up, if the power segment comes back up with renewables, I think it could do very well. So I'm in GE over some of these other value plays like Ford there. What else? Muke wants to know about Lyft. I've actually got Lyft in our stock card portfolio, our 2021 Bowtie Nation portfolio. They're on stock card. You can watch it, follow it for free. I've actually got Lyft in there. I also own shares of Uber, but I think Uber has really come back quite a bit further than whereas Lyft is maybe a little bit more of a value play right now. But I do like it for that longer term. I think it can move beyond some of the fears over this legislation risk that it's got. Not to say that the legislation won't get passed and won't be a near-term catalyst for maybe a little bit lower on the shares, but I think the company works through it and adapts to it to be a very good long-term company. We are heading on into an hour on this, so I'm going to go ahead, and if I didn't get to your question, please ask it in the comments below. It takes usually about half an hour for the video to be processed, and then I'll be able to answer questions from the. Again, watch for those videos coming out this week. Tomorrow, penny stocks for the long run, and a great strategy for penny stock investing, as well as some great videos coming at you Wednesday and Friday. So thanks again, and I'll see you next week.